Welcome back. It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with Jamie Murray. He's portfolio manager and head of research at the Murray Wealth Group to talk about retailing stocks and the backdrop therein, which of course is the consumer spending backdrop, mainly in the United States. Jamie, how well in your mind is the U.S. consumer holding up?
Yeah, we think the U.S. consumer has held up fairly well, particularly in the sort of middle to upper tier in terms of spending. We've certainly seen some pressure on the lower income consumers over the last 2 years with inflation levels and just some pressure on that segment. But we're seeing now finally wages are rising faster than inflation, so real incomes are improving. We think consumer balance sheets still remain pretty healthy and pretty strong. Housing values have held in very well. And so we're seeing, we think, a little bit more of a return to normal spending patterns in the United States.
So what is your take on retailing stocks?
Yeah, we think there's lots of great opportunities in the sector. Like everything, you have to be specific in which names you're looking at. And we've certainly seen over the last 3-4 years separation between winners and losers. And, you know, on the winner side, a couple of names that stand out are the Costco's and Walmart's, who have seen their PE multiples expand just because they've been able to meet and exceed investor profit expectations. And on the flip side, companies that used to be market darlings, like a Dollar General or Target, have struggled to grow their earnings and expand their revenue base. And so we're seeing, again, like the winners and losers in this. And we think that there's a lot of companies that are winning but aren't trading at the same elevated multiples that a Costco is. Like I think most investors would agree that Costco is a phenomenal company, but you're paying a 45 PE ratio for probably 10% EPS growth. And we can find some more discretionary names we think that trade at much lower multiples, in line with their historical averages, but you're seeing earnings growth of 20-25%.
Do you think the same? So you think Costco is richly or fully valued? Do you think the same of Walmart? It has soared over the past year, as you and most viewers know, and the PE multiple there is more than 36 times.
Yeah, Walmart is another name that we think is probably a little bit too elevated in terms of the multiple for what you're getting. Again, obviously a very defensive, strong retailer, but we think there's better opportunities, like I said, more along the discretionary side. A name that we talked about earlier in the show is Aritzia. They're going to report their earnings this week. I mean, I think they're going to be very, very strong earnings. But this is a company that has a huge growth runway in the United States. Their comparable store sales, so the same store sales growth, is accelerating. And this is a company that we think over the next 5 years can grow its earnings at 25% per year. And so this is a much higher growth that you're getting out of this company. Now, it is a little bit higher up the risk curve from a Costco or a Walmart, but it trades at just around 20 times PE multiple, which we think is pretty attractive given the earnings growth that we're expecting from this company.
What is Aritzia management doing correctly?
So Aritzia has always been very good at staying on the right side of the fashion trends. Again, they're not necessarily the leading fashion. They're not in that whether it's luxury or trying to be fast fashion and copy, but they just look to make the best quality item at the price point that they operate at. So they call it affordable luxury. It's certainly a step down from true luxury brands like Louis Vuitton, but they look for premium fabrics, high quality construction, but then an affordable price. And they just want to, so their vegan leather pants, for example, they just want to make the best pair of this that a consumer, they're going to go to the mall, look for this item, and Aritzia is going to have the highest quality item at the best price point. And so they've been very successful with this formula over the last 35 years, and we see no reason why that's going to change going forward.
Which area of U.S. retail would you avoid?
Yeah, that's a good question. I think certainly the dollar stores have been very challenged. They're seeing, again, Walmart, we think is taking share from stores like Dollar General and Dollar Tree, which also owns Family Dollar. We're seeing, Amazon as well start to increase its penetration in more rural markets in the United States. I'm not sure how much Temu, the Chinese e-commerce giant, has affected them, but that's certainly a little bit of pressure. And we just think it's a challenge space, and they've historically relied on same-store sales and increasing their store footprint, but now we're starting to see them roll that back. So it's going to be, we think, a little bit challenging for them to get back to that consistent earnings growth rate pattern.